Hey everyone, this is Kyle from Notional Finance, and you're listening to the Notable Builders podcast. There are more DeFi projects than ever to keep up with, so we're going behind the scenes to chat with the real builders, the people driving innovation, bringing in new users, and creating real value for the entire ecosystem. On this episode, we talked with Mike Saul and Blake West, the co-founders of Goldfinch Finance, which enables under-collateralized lending, bringing crypto loans to real-world applications. We talk a lot about the different risk and reward profiles in DeFi. Of note, Goldfinch has minimal smart contract risk as their funds are deployed off-chain, which in turn exposes the lenders to more credit risk than the average DeFi protocol. Let's get into it. Thanks a lot for joining us today for our first ever Notional and Friends Twitter space. We're really excited to have the Goldfinch team here with us today to just talk a little bit about what's going on in the DeFi lending space and, have a nice chat. We're going to be doing these monthly going forward as just sort of an informal chat with some other protocols. And hopefully in the near future, we'll have some of our integration partners, which we're really excited to share more about soon as those start coming online. For anyone who doesn't know, who's coming maybe from the Goldfinch side of things, Notional makes it possible for anyone to lend or borrow crypto assets at a fixed rate. So unlike other protocols that serve just the lenders at the fixed rates, we actually do borrowers and lenders, so both sides of the market. So that means that the yield generated for the lenders on the platform comes directly from what borrowers are willing to pay to lock in those rates. So, we got some talk of a sideways or bear market right now, but fixed rates can be a pretty great strategy during those times. So anyway, why don't we just do some introductions and get started? Let's just do some introductions. Mike, if you want to start.
Yeah, sure. This is great, by the way. This is my first Twitter Spaces. So
Same.
I'm kind of learning how it works. This is cool. I like these. But yeah, so I'm Mike. I'm one of the co-founders of Goldfinch. Blake is here too. And the background on Goldfinch is we're building a decentralized credit protocol for under-collateralized lending. And the idea behind that is where, if say compared with, say, protocols like Aave and Compound, where you need to put up, say, $150 worth of ETH to borrow $100 worth of another asset, we're building a protocol to make it for borrowers who don't necessarily already have a lot of capital, which is like most borrowers in the world. And so Goldfinch is building this way to get all the crypto capital that is sitting there to be put in the hands of real world borrowers who can put it to productive uses. So that's like the high level background of Goldfinch, and that's who I am.
Cool.
I'm Blake West, other co-founder of Goldfinch and CTO. And for doing Goldfinch, which Mike gave a great intro on, I was a senior engineer at Coinbase, and for that, engineering at Hint Health. I'm really excited to be here. Thanks a lot for bringing me on. This is also my first Twitter space. Someone had to remind me 1 minute beforehand that I need to actually have a Twitter app, and the computer doesn't work.
Nice. All right, and our Notional CEO, Teddy, you want to say hello?
Hey, guys. Actually, Blake, I have made that mistake twice now. So this is the third time's a charm. This is the first time I've actually figured out how to join Twitter Space without, having screwed it up. So I'm Teddy. I'm the co-founder and CEO of Notional.
All right. So we got sort of the overview of Goldfinch, and I think it's really cool to start off with you guys because obviously, Notional is more on the over-collateralized loans side of things. So it's really interesting to get this perspective of under-collateralized loans. So what's the thesis on why this works or can work in DeFi, and maybe why the greater, finance ecosystem really needs it?
Yeah, well, to start with the greater finance ecosystem, when we look at the sort of over-collateralized lending that's happening, say, on Compound, that's super useful for margin traders or investors who want to get kind of liquidity on their positions without already selling what they have. I mean, most folks in the world, the reason why they want to borrow money is they don't already have money. So in order for crypto and DeFi to actually enable access to capital around the world and help improve financial systems around the world, it needs to be able to provide loans to people who need money in a way where they don't already have it. And so we started thinking this is, for us, this felt like a holy grail of DeFi. If you can do that, then DeFi can start really breaking out into global debt markets and broader economies. And so we were trying to figure out a way to solve this. And we can chat about the core mechanics of how it works, but the crux of how we're trying to get it to work is rather than using the amount of crypto that you have as a measure of your creditworthiness, which is what these other protocols use, is using off-chain information to evaluate whether you're creditworthy. And the way that Goldfinch does this is the concept of trust through consensus. What we mean by that is when you have the consensus of a lot of people who all agree that a borrower is creditworthy, then it probably means that they are more likely to be creditworthy. And so the protocol uses that concept to allocate capital where when a group of people all agree that someone is creditworthy and they provide capital in a risky way to that person, then the protocol can view that person as trustworthy and allocate even more capital from an aggregated pool. And so this trust through consensus is the method where we sort of have human judgment determining creditworthiness for folks who don't already have the crypto that is used to determine creditworthiness in sort of the existing DeFi protocols.
Yeah, I might just add one thing there, which I think one of the things that crypto systems are so good at is using things like a token and game theory and economics to coordinate the actions of individuals around the world. It's kind of how a lot of the blockchains work. And I view part of what Goldfinch is doing is trying to do that. And as Mike was saying, scaling human judgment through the backer community that we've been building. But you really use the protocol thing to scale that judgment in a way that can allow you to actually do under collateralized lending.
That's cool. So what is the consensus mechanism that you guys have built or are using, and what does that look like in practice?
So I think it's helpful here to just kind of take one step back to understand who the kind of actors are in the system. And so Goldfinch has three main actors. There's borrowers, what we call backers, and there's LPs. And so the borrowers, so far borrowers have tended to be actually fintech companies in emerging markets, places like Kenya, Nigeria, Mexico, Southeast Asia, who have great businesses and awesome track records, but there's not as much access to capital in some of these markets as there is in the West. And so, they're coming to Goldfinch looking for loans. And then you have these other two players, the backers and the LPs. So backers you can think of as being more active, and they're the ones taking the most risk. They put capital into specific deals that a borrower might bring. So if a borrower says, hey, I want to take out a loan for $1 million, they bring that to the community of backers directly. And they share all sorts of information, data rooms. They can have Discord channels and YouTube live AMAs. That's all that's been happening so far on the Goldfinch protocol. And they're basically making their case, right, that we're a creditworthy borrower to this community of backers. Then backers have to put their money where their mouth is and actually put capital into that specific deal. And they are the riskiest capital. They're going to be the first loss. And so they have a really high incentive to make sure they pick right. And then behind them, you have these LPs. And so LPs are our term of people who put capital into a aggregated senior pool. And so that senior pool then automatically allocates capital according to this notion of trust through consensus that Mike was alluding to. And so basically the way that kind of works in practice is a deal will come on to the protocol and backers put capital into it. If there's this kind of sufficient number of backers to be putting capital in, then additional capital from the senior pool gets put in. And sort of the general idea is the more backers who put capital in, then the more that pool can be trusted, and therefore the higher what we call like leverage ratio that the senior pool can put into that given deal.
Sorry, Kyle, I just wanted to ask a quick question here. So what is Goldfinch enabling that can't be done today? Because the way you've described your model, there's a lot of sort of human interaction. And I'm curious what you guys are doing that enables these guys to do stuff that they couldn't already do.
Yeah, that's a great question. So there is lending that happens today, but there's a lot of frictions. And so we can talk about some of the individual types of borrowers and why this is beneficial to them. And then also at a meta level, like what does crypto do for financial systems in general that make it so much better? So for these individual types of borrowers, these are businesses that are borrowing from the protocol. They're in markets around the world, in Nigeria and Brazil and Indonesia and Kenya. And what we find is that when they're looking for, say, a few $100,000 up to, say, $10, $20 million in that range, their local capital markets can supply capital lower than that range. But when you start getting to hundreds of thousands of dollars, it becomes difficult for businesses in these markets to get the capital of larger check sizes because the local capital markets just aren't that developed. And a lot of these countries have really high yield government bonds. So people just put the money, or banks will just put money in those government bonds instead of supplying it to, like, lending it to these kinds of companies. But then for these kinds of companies, if they want to go and get capital from foreign investors, say in Western countries or in the US or in Europe, a lot of these global institutional funds, they have like minimum check sizes of $30-40 million. And so you have to be a much bigger company for them to spend the time to give you the loan. So these companies have these great profitable businesses. They're trying to expand their operations and they can't get the capital. And when we were first working on Goldfinch at the early days, we were talking to dozens of these businesses and they were saying the same thing over and over again, which is like they spend half their time trying to get this capital. It can take months and months if they are able to even get it at all. And like at the end of the conversations, they would be like, when can we use Goldfinch? We want to get started now. We hadn't even started working on it yet. So we were just seeing that this is like a huge friction point for these businesses. So that's sort of like what it's doing at the like individual unit level. But at a sort of broader macroeconomic level, what crypto does for the financial markets are two big things. One is it expands access. So if you want to participate in these kinds of private corporate debt deals today and that go through these credit funds, in the US, you need to be usually a qualified investor, which means you need to have at least $25 million just to be participating in one of these funds. But what crypto can do is make it way easier to have this capital formation and expand the access to anyone around the world. And then the second big part is, in addition to access, is the liquidity. So if you want to participate in one of these credit funds, you got to provide the capital. It's going to get locked up for 5, 6, 7 plus years. But with crypto, it's easy to create secondary markets on top of it. And so you can provide the capital in there, and then you can get liquidity on it later on, even while it's out serving productive means. And so with that liquidity, we think that both makes it easier to participate and will eventually bring down the cost of capital because you have more people participating and there's no liquidity premium. And so then that brings down the cost of capital. And so these two things at a macro level are just much, much easier and much, much better than sort of traditional credit funds and how that works. So that's at both the like micro level and macro level of what Goldfinch is really accomplishing for these folks. I don't know, Blake, if you wanted to add anything to that.
I might just add that I think because of the kind of advantages that Mike is talking about here, liquidity, access, and then I would also add, of course, the other things that DeFi offers, global by default, interoperability, quick finality, and things like that. Those are all reasons why we just see that over the next 5-10 years, all of private debt is going to be moving on chain. And I think Ethereum or some blockchain is going to become this global sink of capital. And so we see this is the future of where finance is headed. And so where all of private debt is going to be on chain, and there needs to be a marketplace to organize that private debt. And so that's kind of what we're building at Goldfinch.
Nice. Yeah, I think that makes a lot of sense. So like in regards to the trust that I feel like there's a bit more of this trust that goes on when you're dealing with off-chain actors. And with Notional, we talk about, there's smart contract risk and the protocol insolvency risk and rapid market drawdowns. What does the risk profile look for users on Goldfinch? And has there been any interesting issues regarding some of your borrowers?
I think, Goldfinch, of course, being on DeFi also has smart contract risk for sure. And we have, there's a world-class team of engineers who's been building the smart contracts. We put security as top priority and make sure everything is audited and doing unit tests and testnet testing and mainnet forking testing, all of that. And then I think stuff that's more specific to Goldfinch is the credit risk aspect, right? The backers do have to put their trust in these borrowers, but the borrowers have track record, right? They have off-chain reputation they want to maintain. Also, I think it's important to realize that the borrowers have a strong reason to want to borrow again because all these borrowers are in fact lending companies, right? They take the money and then they turn around and lend it to individuals or small businesses around the world. And so having access to capital, that is a productive asset for them. And that is how they grow their business. It's extremely important that they maintain their access to capital, not just now, but going forward in the future. So they're not just taking it to, build a building. They're using money and every dollar of it can be put to productive use. So the borrowers have a really strong incentive to want to pay back because it's key to their whole business. And that's, I think, part of why backers are interested in funding these borrowers. But I'd say that credit risk aspect is probably the main kind of special thing about Goldfinch compared to other DeFi protocols.
It's actually interesting because I know now with the markets and crypto and declining and risks of liquidations isn't a concept on Goldfinch. Liquidations don't happen. The risk with Goldfinch is that one of these individual borrowers is late on a payment or something, or comes time for them to pay back their principal, they have trouble getting the capital to pay it. So there's no systemic liquidation kind of risk with the broader macro markets. It would be maybe if a global economy is struggling in all 18 countries that these borrowers are from, and so they're all struggling to get the capital to pay back their loans, that would be a scenario where you would start to see potentially like late payments on the loans or having trouble paying it back. And that's where the credit risk is. But the broader kind of interesting thing is all tied to sort of off-chain, real-world kind of activity, and there wouldn't be like a particular moment where it all kind of gets liquidated all at once.
I might just quickly add that you had asked before about there been any issues with borrowers or anything right now, and say no, there's not. Default rates are 0% over the last year plus that we've been doing loans.
Yeah, it's interesting. I'm curious on your end too, on the notional side. It's probably different, right? There's more of the liquidation aspect to it, right? But then it's not like a scenario where you're waiting for individual borrowers to make their payments.
Yeah, that's correct. So basically, the way it works in an over-collateralized lending protocol like Notional is that liquidations actually are what protect the lenders. So liquidations aren't sort of a bad thing, if you will. I mean, it's bad for borrowers because borrowers don't want to get liquidated, but the process of liquidation is what ensures that borrowers don't default on their obligations.
Yeah, definitely.
Cool. And so how do you find these on the ground partners? I mean, you talked about like how they obviously have the incentive to borrow again, and so you should have a lot of repeat customers. What does that look like as far as prospecting for these borrowers?
In the very early stages, it was us just kind of reaching out to our personal networks, getting connected with businesses that were interested. Now what we're finding is a lot of borrowers are coming to us, and we're getting connected with credit funds. And the credit funds are super interested in using Goldfinch because they often struggle to raise capital quickly for their funds. But what they are is they're like pros in this, and they know a lot of these companies around the world. So they're almost acting as this in between. They're almost like originators reaching out and finding these borrowers. And so now we're seeing both borrowers and credit funds starting to reach out to the community wanting to participate. And so it started to become more of an organic process there.
Cool. And what do the rates look like for the pools in Goldfinch?
Yeah, for a lot of these loans, they are like it's been doing basically market rates in these countries, and so the interest rate, like the coupon rate on these loans, tend to be in the range of 10 to 15%, and that is dependent upon like what the market rates are in different countries. So in certain areas, the rates are lower, but that's the coupon rate, and then the way it ends up looking in terms of yield for people who provide capital to the protocol is it's different if they participate in the senior pool versus in the individual borrower pools where they provide first loss capital as backers. So for the senior pool, the way it works is the yields are going to be in the range of like 7 to 10% because there's like a 10% fee that goes to the protocol, and then 20% of the interest is reallocated to the backers. So the senior pool sees effectively 70% of the interest coming in, and so that's where it is at 7 to 10%. It also depends on the utilization of the pool. On the backer side of things, there's that 10% fee, but then they're also seeing the 20% of the interest that's reallocated to them. So it depends on what that leverage ratio is, but generally speaking, with leverage ratios in around like 3x or so, the yields for the backers are around like 15 to 18% interest.
Okay.
So those are all being USDC terms. Everything is done in USDC, and that's all completely uncorrelated with the rest of the crypto markets, right? So whether crypto is going up or down, those rates are going to stay steady. And both of them currently have additional token yield from liquidity mining that's going on through the Goldfinch protocol.
Got it. And maybe Teddy, do you want to talk a little bit about like where rates are at Notional right now and how you see that developing right now?
Yeah, I think rates on USDC on Notional are currently in the sort of 8 to 9.5% range. So pretty similar to the what you guys have on your senior tranche, which is interesting. I think the reality is that sort of the crypto markets are still pretty inefficient, and it's going to take a while for the market to sort of sort out what the sort of rates should be relative to each other. What is riskier here? In one sense, on your protocol, the senior tranche, they have this sort of loss buffer that's provided by what you call the backers. On our protocol, we have this sort of the over collateralization, which is basically how we make sure that all the borrowers don't default. But on the other hand, I suppose we both have smart contract risk. Because they're different risks, right? So I think only time will tell how the market decides to sort of say which one is riskier.
Yeah, it's going to be interesting to see how that plays out. It's interesting how you mentioned the smart contract risk, because I think of, I think Goldfinch has more inherent like actual credit risk, whereas, I mean, there isn't really credit risk on the notional side. It's all baked into the logic. But then I would say on the Goldfinch side, I think the smart contract risk is a little bit lower because there isn't really like a honeypot of capital sitting on Goldfinch. It's now in the hands of over 230,000 people around the world that are receiving the capital and paying back loans. And so the fact that the capital is like out in the real world and not sitting in the contract means that if there were some crazy hack, there isn't actually as much capital just like sitting literally right there to be grabbed because it's not there. So I think in some ways, Goldfinch might have lower smart contract risk to an extent, but then also it's kind of replaced by this other kind of traditional credit risk.
Yeah, I would agree with that. I haven't really taken a look at your guys' smart contracts or anything, but I would just guess from what I'm sort of hearing here that there's just more moving parts to notional smart contracts. That would just be my guess because we have to do all this, we have to check everybody's collateral all the time. And in the event that there are liquidations, they have to be well executed. So I think you're probably right that there's a greater degree of smart contract risk on notional. So I think it's really just a matter of, what are you most comfortable with, like smart contract risk or credit risk, and like how those two things are priced.
Yeah, it might even be good to frame it as different types of risk, I guess. It doesn't have to be one versus the other, but yeah, there's different profiles.
Because there are also those two types of risks, as you're saying. They're going to behave differently in different circumstances. And this is why I think, Goldfinch is really complementary to a lot of the other lending and savings protocols that are out there because I was saying we're more uncorrelated with the rest of crypto. We have this different types of risk. And so, I think a sort of well-balanced portfolio would probably have positions in all of them.
I like that. I think that's good.
For sure. And just moving forward just a little bit, I know you guys recently launched your token. And so just curious to see what's the plan in terms of utility and what you're thinking on community governance with that?
Yeah, well, as part of launching the token, we also turned the protocol over to the community. Essentially, we launched governance as well. So there's like the whole governance forum where there's already been proposals being made. And then there's for snapshot voting, governance, the community can already vote. So we had our first vote that was sort of voted on through Snapshot that passed earlier this week on Monday. And that's like the primary way to use the token right now. There's future ways that we think the community is going to introduce to the protocol that are described in the white paper, both from the auditors participating and like staking on backers. But right now, the primary use is for governance. And one thing that's like pretty cool about the way Goldfinch has set up governance is it uses quadratic voting, which I feel like Blake has been like a long time proponent of the quadratic voting process. I think you should talk about that one a little bit.
Yeah, sure. So this was something I was super excited that we were able to do. So many of you may know or have been quadratic voting has been talked about for a long time in the crypto community. Vitalik and Glenn Weil wrote a paper on it a couple of years ago. And, the idea is just that it sort of limits, I guess, the power of large token holders because you get the square root of their token holdings. And it adds more power to the positions that are voted on that have a lot of individuals who want that position to pass. So, at a technical level, it takes the square root of all the token holding, sums them together, and then squares it again. But really what this has the effect of is that if you get a lot of individuals to support a position, that's going to be much more powerful than just having a lot of tokens. So Glenn and Vitalik have all their math explaining why this is actually really great from a general sort of public benefit standpoint. And it's something that Goldfinch was kind of uniquely able to add because this ties in with the trust through consensus mechanism that we have. Goldfinch requires a way to have civil resistance at its heart. Those backers, because you're relying on the number of backers who put capital into a deal as a signal for trust, it can't just be the thing where backers can just spin up 1,000 addresses and put capital into a pool. So Goldfinch had to solve this problem, and we went about it by having this product out called UID. It was launched late last year. And any protocol can use it. It's a smart contract. It's just an NFT. It's really simple at its heart. It's an NFT for ID. And what it represents is that there's been a KYC process on an individual. No data is stored on chain. There's no privacy issues. It's just got KYC and kind of true false. And that NFT as being not transferable, it's pretty hard to replicate. And so we can use that as the civil resistance. And that's key to making the voting work. So you have to have a UID and the Goldfinch tokens in order to be able to vote. We actually wrote a custom snapshot strategy for this. So any other protocol founders that want to use it, they can also use that strategy, and they can use UID or any other form of membership that they want. The strategy would also allow you to say, oh, you have to own a CryptoPunk to count for voting as well. Yes, that's one of the things that Goldfinch is doing, and we're really excited about that aspect of it. I think it's a really cool governance mechanism.
That is awesome, and that's awesome that it's something that's available for other protocols to take a look at and potentially take advantage of. I want to save some time for some Q&A, but a couple quick questions. I mean, this is 2022 is the year of the L2. So does Goldfinch need an L2 solution as badly as some of these other protocols? Like obviously Notional does. What's your guys' plan on that?
Yeah, I think that Goldfinch probably doesn't need one quite as badly as some other protocols. This is actually something we thought about from the very beginning when we were starting the protocol. The fact that we have our borrowers are companies, they're borrowing millions of dollars at a time, means that gas costs are just not a big deal for them, right? Even if they pay $200 to draw down from the protocol, if you're borrowing $5 million, it's kind of negligible. And in fact, it's actually way better than the rates they currently get when they borrow. Often there's like 1% drawdown fees in the traditional world, just for the pleasure of taking someone's money. So, and the fact that they only pay $200 on a $10 million loan is like amazing to them. That doesn't mean it's not as big a deal for them. Obviously, it's still a big deal from the LP and the backer side of things. They would love to see the gas costs be lower, and we would too. It also opens up a lot of design space. So I think it's definitely something the Goldfinch community is going to want to do, and I foresee that happening. Hard to say exactly when, but I would hope within a year.
Of course. Yeah, Teddy, do you want to talk real fast about what you can say on our Notional end?
Yeah, so I think so, Blake, to your points about your companies are borrowing large amounts of money, and so kind of the gas fees on Ethereum L1 are less of a big deal. That's kind of I think it's really the future for any protocol on L1. Is just basically you're going to be working with just larger dollar amounts. And so, what Notional has seen so far is basically that kind of the user base that we're looking at, it's really large funds and also sort of like protocol to protocol partnerships. So, we've got upcoming integrations with Yearn and potentially Index Coop as well to launch like a bond ETF. And so both of those things kind of perform a similar function where it allows smaller dollar users a cheap way of aggregating their funds and just batching up a bunch of transactions into one big transaction. Right. So Yearn, they're managing $400 million in their USDC vaults. They can just go lend $10 million or $50 million or whatever they want on Notional in one clip. Right. And then as a user, all you have to do is subscribe to the Yearn vault, and it socializes the gas costs among everybody. And definitely Notional wants to go to L2. We can just broaden access to the system and let people use it directly with smaller dollar amounts. But I think that, even on L1, we already have solutions that allow people to sort of aggregate orders. And I think that's increasingly just what Ethereum L1 is going to look like.
Yeah, I think that makes a lot of sense. Yeah, I think let's sort of wrap this up unless there's anything, Blake or Mike, you want to add. But if anybody wants to contribute, feel free to send a request in and I'll put you up there. Give it a few minutes and see.
Yeah, that's cool. I'm curious to see if folks have questions. Yeah, but what you were describing, Teddy, that's awesome. I'm very curious to see with the Goldfinch community how it works in terms of forming partnerships with other communities and how those come about, because we're in the super early stages there. I think there's a lot of potential there to do that. I don't know how it even works, basically, of forming these partnerships with other protocols.
Yeah, I think that's what's really cool about DeFi. It's a strategy that we've sort of tried to pursue pretty aggressively here, and I think we're going to have some real success because of it. So kind of as I was saying with Yearn and Index Coop and stuff like that, it really helps. I would say that is one of the merits of having a completely on-chain smart contract system. Is when there's no human input, basically the developers from sort of both sides, you can just look at the other system and know how it works. It's just sort of fitting two machines together. There's less friction because there's zero ambiguity because everything is based on code. That makes it easier to do.
Yeah. All right, I think we got one request here. Short consensus.
Hey guys, thank you for hosting this space. I'm really excited about the Goldfinch product. I'm actually a PM in consumer credit space in the US. Work with most of the big fintech names that you know. So I'm really excited about broadening access to credit all over the world. So one thing, if the goal is to lower the cost of capital, raise to zero, I think one critical component is to move credit reputation on chain. Do you guys have plans of making essentially a credit report for these fintech lenders that you have all over the world, so that people like me and others, we're going to race to the bottom on underwriting those borrowers to the exact risk? But if we can't see the data, that's hard. I mean, is that in the roadmap, or how are you guys thinking about that?
So yeah, I think just to be clear about what is and isn't on chain. So all of the drawdowns and the payments and the investments from backers and all that is all fully on chain. And so over time, as the borrowers repay their loans, as many borrowers already have been doing on Goldfinch, their track record is getting built up. And so, what isn't on chain, what the backers look at that's off chain is their kind of existing real world track record, right? Things like their data room, who their investors are, who their team is, stuff that sort of, I guess in theory, right, you could put that information on Arweave, but it's still just a representation of information. You wouldn't have real security that it's necessarily true just because it's on IPFS or Arweave or something. That economic information, that's the real key, and that is on chain. So what we've always imagined is that as these borrowers build up those track records, well, over time, there will be enough information to just create credit reports. And that doesn't have to be coming from our team or anything like that. That can come from, really anybody in the world, or any analysis or, model that someone wants to create. They're all going to have access to the same data. And I would imagine there will be, a marketplace of competing reports and stuff on these different borrowers but it's going to take a little while to get there, because you really need that track record to build up.
Yeah, totally. And when are you guys thinking of working with U.S. lenders right now?
And when you say U.S. lenders, do you mean lending companies?
Yeah,
like who might want to be borrowers?
Like small fintech companies. Because I'm seeing on one side Spring Labs working on basically bringing the TransUnion credit report in some form on chain, and then you have what you guys are doing also. Like, I can tell you from my perspective, we may be willing to take the equity risk, but in some cases it's really hard to get what you're calling the senior financing here. Like, you have to deal with a bank, and it's a pain. So I'm really excited about that part too. Just curious about, in general, how are you guys thinking about the US?
Yeah, Goldfinch is a global protocol, and there's no hard restrictions or anything on whether or not U.S. companies wanted to try and get loans from the Goldfinch community. They're free to kind of apply to do that. I would say it's been a lot of non-U.S. companies so far, largely because that's just where the biggest need is, and it's where the largest sort of dearth of capital has been, and so there's the biggest gap, and Goldfinch is providing the most value there. But there's nothing inherent at all about restricting that to non-U.S. And, we'd love to see U.S. lenders come and pitch to the Goldfinch community.
Yeah, to add to that, it'll depend on who the backers decide to provide capital to, but I wouldn't be surprised if there start to be more like U.S. kinds of borrowers, or even in Europe over the next year or so. It'll just depend on sort of, are they offering good opportunities and what the yields are, and do the backers want to fund it?
I think we got one other question here from TF.
Hey, so something that really resonates with me kind of about the vision here is the idea of empowerment in terms of financial inclusion. And I think that's great in terms of looking to emerging markets and building kind of businesses there and allowing them to build their businesses. And then there's also this aspect of empowering, like it says on your website, anyone to be a lender. I'm just curious about kind of how you bring those two together, or how you develop empowering anyone in the long term to be a lender. Because right now I understand it's like PayJoy and these different companies that are seasoned financiers and able to provide capital. I guess the risk increases with retail lenders or anyone being a lender, and the borrowers not being able to pay back. I'm just curious about the long-term vision there for anyone being a lender.
I can see this going in a bunch of different directions, essentially. I think this is like a broad aspect of the protocol where it's anyone who is essentially a borrower can go to the community, and anyone in the community can evaluate that borrower and decide to provide capital, and it's an open sort of system there. And so that means that you could have it being with really large businesses, or you could have it be really small businesses, or like really small lenders. And so I remember when we were early on talking to folks, we were talking to someone who was in Bogota, and what he was doing was like giving individual loans out to people he knew so that they could get a bike because they were doing like sort of gig economy deliveries, and he would give them like very small loans at however much a bike costs in Bogota to like buy a bike, and so they could like do more deliveries faster. And we were like, oh, what if like this person could raise capital from the crypto community so that he can make more of these loans out to folks he knows in his local community, so they can buy bikes and they can be more productive, and like he knows them all, so they're all paying back well. And then I could see right now is starting off with these really sort of larger businesses who are taking out really significant ones that have track records. But what would it mean for someone like him to go to the community and say like, hey, here's my story here, here's what I'm using the capital for. And if he can just convince a few backers to provide some of that additional capital, like that's one way where he could get started and ramping things up. And it's like at that stage, it would be a small amount getting started, and then could gradually grow and show more of his activity over time and expand with it. So that's how I kind of see that like anyone can be a lender. It's both anyone can be kind of enterprising and like share opportunities if they can convince the community to help them do that. Plus, on the other side of backers, anyone can be a backer and look at all the different opportunities and decide which ones they want to help support. So there's like a couple layers to that where I see it sort of headed.
Those are all great thoughts. I just, might add one thing, which is I think there's the borrower aspect to saying, anyone can be a borrower, and can retail borrowers come onto Goldfinch? As Mike was saying, yes, there's nothing that would stop that in theory. I do think economically it will generally kind of make sense for larger dollar borrowers to exist. And that really just fundamentally comes down to the fact that we use this notion of trust through consensus. And consensus is expensive, right? It takes a lot of people looking at something. And for it to be worth it for those people to put their own money in, and the fact that you have a lot of people putting money in, kind of just fundamentally there, the total amount that's being borrowed needs to be at least reasonably high. I don't think necessarily needs to be millions of dollars the way it is today, but it needs to be kind of high. And so I think that's an important aspect just of that, how that goes. And so I've, kind of imagined that what we might see in sort of the long future is like smart contracts that run strategies that people can deposit into, a bit like Yearn, but in a future where there's a lot more economic activity on chain, and those smart contracts can interact with more real world transactions as people start doing more everyday things with crypto. I think that's a really cool future that we'd like to get to, where that full life cycle of payments is on chain and it's interacting with more real world things. And these, you have 100 smart contract strategies. There's a whole marketplace of backers trying to decide which of those strategies is best.
Cool. Thank you.
I think that's super interesting discussion. Any other questions from the audience? Doesn't really look like it. So yeah, I just want to say thank you all for coming. Obviously, thanks to the Goldfinch team. We'll do this again in the future. I think just super interesting to start out with you guys, because like Notional, we talked about kind of uncorrelated from the rest of the crypto market. If the rest of the crypto market's going down, the yields on Goldfinch and Notional are really just sort of a separate thing, and can be a really good strategy for those looking for yield that isn't so dependent on, a token price continuing to go up. So that's awesome. Any final thoughts or anything? Feel free to jump in. Otherwise, we'll talk to you guys soon.